Look, I need to tell you something that happened just a few weeks ago, and honestly, it should have been breaking news on every financial channel out there. But instead, buried in regulatory filings that most people never read, released at the end of a trading day when everyone's already checked out mentally. Major financial institutions across America have been quietly repositioning their portfolios in ways we haven't seen since right before the 2008 crisis. We're talking about systematic shifts away from what everyone's been told is the absolute safest place to park money: United States government debt. Here's what's actually documented. Over the past 18 months, the largest banks and financial institutions in this country have collectively reduced their exposure to Treasury securities by staggering amounts, not small adjustments, not routine rebalancing. We're looking at strategic repositioning that tells a very different story than what you're hearing on CNBC. And here's the thing that keeps me up at night. These aren't amateurs making emotional decisions. These are institutions with access to data you and I will never see, running models that cost millions to develop, staffed by people whose entire careers depend on being right about this stuff. So when they start moving in the same direction at the same time, heading for the exits on supposedly risk-free assets, maybe we should pay attention, because by the time this becomes obvious to everyone else, the smart money will already be positioned, and the rest of us? We'll be the ones left holding the bag. Let me walk you through what's actually happening right now, why it matters more than anything else in finance, and what you can do about it while there's still time to act. First, let's talk about what Treasury bonds actually are, because understanding this is critical to everything else. When you buy a U.S. Treasury bond, you're essentially lending money to the federal government. They promise to pay you back with interest. Simple enough, right? These bonds come in different flavors: short-term bills that mature in weeks or months, notes that run anywhere from 2 to 10 years, and long-term bonds stretching out 30 years. The longer you're willing to lock up your money, typically the higher the interest rate you'll receive. But here's where it gets interesting, and this is the part most people miss completely. Bond prices and interest rates move in opposite directions. Always. It's not a theory or a prediction. It's mathematical certainty. Think about it this way. Imagine you bought a Treasury bond back in 2020 when rates were basically zero. You picked up a 10-year bond paying maybe 1.5% annual interest. You paid $1,000 for it. Fast forward to today, and interest rates have climbed significantly. New 10-year bonds are now paying close to 4.5%. So here's the problem. Why would anyone give you $1,000 for your bond that only pays 1.5% when they could buy a brand new one paying 4.5% for the same $1,000? They wouldn't, obviously. If you need to sell your bond today, you're taking a haircut. Maybe you get $750 for it. Maybe less. You're locking in a real loss. This is called an unrealized loss when you're just holding the bond. And if you're a major financial institution sitting on billions or trillions worth of bonds purchased when rates were low, your entire bond portfolio just got hammered when the Federal Reserve jacked up interest rates over the past few years. Remember Silicon Valley Bank? March 2023. They went from operating normally to completely shut down in under 48 hours. The reason? They had massive positions in Treasury bonds purchased during the ultra-low rate environment. When those bond values crashed due to rising rates, and depositors started getting nervous and pulling their money out, SVB had to sell bonds at huge losses to raise cash. Those losses obliterated their capital base. Bank gone. Just like that. And that wasn't some isolated incident. Signature Bank collapsed. First Republic collapsed. The Fed had to step in with emergency programs to prevent a full-blown banking crisis. All because of what happens to bond portfolios when interest rates rise sharply. Now scale that up. What happens when the largest financial institutions in the world, holding trillions in Treasury bonds, see something on the horizon that makes them start selling now, taking smaller losses today to avoid potentially catastrophic losses tomorrow? That's exactly what's been happening. And the numbers are staggering. Let me give you the actual data. In recent regulatory filings, major U.S. banks have disclosed significant reductions in their government securities holdings. We're not talking about minor tweaks. JPMorgan Chase has reduced available-for-sale securities portfolios by double-digit percentages. Bank of America has sold tens of billions in securities. Regional banks collectively have reduced holdings by hundreds of billions. When you add it all up across the major institutions, we're looking at a coordinated move away from Treasuries on a scale that should terrify anyone paying attention. These institutions are voluntarily taking losses now. Think about that. They're recognizing hits to their balance sheets that they could avoid by simply holding these bonds to maturity. Why would they do that? Why take guaranteed losses today unless they're seeing something worse coming down the pike? The answer lies in understanding the trap the United States government has gotten itself into. And trust me, this is where things get really uncomfortable. As of early February 2026, the U.S. national debt stands at $38.43 trillion. Not billion, trillion, with a T. To put that in perspective, that's more than $112,000 for every single person in America. For every household, it's over $285,000. But raw numbers don't tell the full story. What matters is the cost of servicing that debt, the interest payments. And this is where things spiral out of control fast. Right now, the Federal Reserve has interest rates in the 3.5% to 3.75% range. That's actually down from the peak we saw in 2023, when rates briefly touched 5.5%. But even at current levels, the interest burden on $38 trillion is crushing. In fiscal year 2024, the United States government paid $879 billion just in interest, not building schools, not fixing roads, not funding defense, just interest, the cost of past borrowing. Latest projections for fiscal 2026 show interest payments will exceed $1.1 trillion. Let that sink in. Over $1 trillion annually just servicing the debt. That's more than we spend on Medicaid. It's approaching what we spend on Social Security. It's becoming one of the largest line items in the entire federal budget. And here's the nightmare scenario. The government doesn't have an extra trillion lying around. So how do they pay it? They borrow more money. They issue more bonds, which increases the total debt, which means next year the interest payment is even higher, which means they have to borrow even more. This is what's called a debt spiral. And there are only a few ways out of it, none of them good. You can drastically cut spending, politically impossible. You can dramatically raise taxes, economically destructive. You can grow the economy so fast that revenues increase faster than debt, not happening. You can print money, creates inflation, or you can default. Those are your options. Pick your poison. Now add another layer to this mess. About $9 trillion of U.S. debt is owned by foreign countries. The biggest holders traditionally have been Japan and China. Japan currently holds around $1.1 trillion. China's down to about $757 billion from over $1 trillion a few years ago. These countries buy our debt because they need somewhere safe to park their trade surplus dollars. But something changed in the past couple of years. They started selling. China has reduced its treasury holdings by roughly 24% since 2013. Japan trimmed its holdings significantly in 2024. When foreign central banks start backing away from U.S. debt, somebody else has to buy it. And increasingly, that somebody is the U.S. government itself. The Federal Reserve, the Treasury Department, domestic institutions, they're absorbing debt that foreign buyers don't want anymore. This creates what I call the doom loop. The government borrows money. Foreign buyers don't want it. Domestic buyers are selling it, so the Federal Reserve steps in and buys it with newly created money. That increases the money supply. That causes inflation. To fight inflation, the Fed has to raise interest rates. Higher rates make the debt more expensive to service, which requires more borrowing, which requires more money creation, which causes more inflation. You see the trap? It's mathematical. It's unavoidable at this point, and the major financial institutions see it clearly. Let me take you back to a moment in history that rhymes perfectly with today. The year is 1979. America is in crisis. Inflation is running north of 13% annually. Gas lines stretch for blocks. The economy is stagnant while unemployment climbs. International confidence in the dollar is collapsing. Foreign governments are demanding gold instead of dollars. President Carter goes on national television and delivers what becomes known as the Malaise speech, talking about a crisis of confidence gripping the nation. Into this mess steps Paul Volcker. He becomes Fed chairman in August 1979, and he makes a decision that changes everything. He's going to break inflation no matter what it costs. He raises interest rates to 20%. 20%. It works. Inflation gets crushed. But the side effects are brutal. Unemployment hits nearly 11%. Thousands of businesses fail. The savings and loan industry collapses. Farmers lose their land. The pain is immense and widespread. But here's the critical detail everyone forgets. In 1979, when Volcker started raising rates, the total U.S. national debt was $845 billion. The debt-to-GDP ratio was around 32%. Today, the debt is $38.43 trillion. That's 45 times larger in absolute terms. The debt-to-GDP ratio is around 124%, nearly 4 times higher relative to the size of the economy. Do you understand what that means? Volcker could raise rates to 20% because the debt was manageable. Even at those crushing rates, the interest payments wouldn't bankrupt the government. Today, if the Fed tried to raise rates to 20% to fight inflation, the interest on $38 trillion would be roughly $7.6 trillion per year. That's more than the entire federal budget. The government couldn't survive. They'd either have to default or print money so aggressively that the dollar would collapse. The Volcker option doesn't exist anymore. The debt is too large. The Fed is trapped. If inflation resurges, they can't raise rates high enough to stop it without destroying the government's ability to pay its bills. And if they keep rates low to protect the government, inflation spirals out of control and destroys the currency anyway. This is the trap that institutions are seeing. This is why they're repositioning. Because in a debt trap, bonds are the worst possible place to be. If the government prints money to avoid default, inflation destroys bond values. If the government tries to raise rates to fight inflation, the economy collapses and the government defaults. Either way, bondholders lose. Let me show you another historical parallel. Japan, in the 1990s, they entered a debt spiral with a debt-to-GDP ratio around 60%. They tried to manage it with low interest rates and money printing. 3 decades later, Japan's debt-to-GDP ratio is 264%. They never escaped. The trap just got deeper. The United States is following the exact same playbook, debt rising faster than GDP. Interest rates kept artificially low to avoid a debt crisis, deficits every single year, and now the institutions that understand this pattern are getting out. So, what happens when this system breaks? Because it's not a question of if, it's a question of when, and the when might be much closer than most people think. Stage 1 is what we're experiencing right now. Banks are repositioning. Foreign governments are reducing holdings, but the system is still functioning. The government can still borrow, just at higher rates. Interest payments are massive but technically manageable. The economy is slowing but not crashing. This stage can last months or even a couple years, but it's fundamentally unstable. Stage 2 begins when something cracks the confidence. Maybe it's another bank failure larger than Silicon Valley Bank. Maybe it's a sovereign default somewhere in Europe or an emerging market. Maybe it's a geopolitical event that disrupts global trade. Maybe it's an inflation spike that forces the Fed into a corner. The specific trigger doesn't matter as much as understanding that confidence in bond markets is fragile, and when it cracks, things accelerate rapidly. Silicon Valley Bank went from solvent to gone in 48 hours. On Wednesday morning, they were a functioning bank. By Friday afternoon, they'd ceased to exist. Depositors tried to withdraw $142 billion in a single day. The bank couldn't meet the demand. Game over. Now imagine that happening to the Treasury market. Bond prices start falling. Maybe inflation data comes in hot. Maybe a foreign country dumps $100 billion in Treasuries to defend their currency. The reason doesn't matter. Prices fall. When bond prices fall, institutions holding those bonds take losses. Those losses reduce their capital. Regulators force them to sell assets to maintain capital ratios. They sell more bonds. Prices fall further. A feedback loop kicks in. At the same time, as bond prices fall, yields rise. Remember, they move opposite. So now the U.S. government is trying to borrow money at higher and higher interest rates. The cost of servicing the debt explodes. The deficit gets worse. They have to issue even more bonds to cover the interest. But the market doesn't want them. Yields spike even higher. This is stage 3, the cascade. Bond prices in freefall. Yields spiking. Banks forced to sell. Foreign buyers pulling back. The Federal Reserve trying to intervene by buying bonds with printed money. But the more they print, the more inflation rises. And rising inflation makes bondholders demand even higher yields to compensate. The spiral accelerates. Then comes stage 4. The government faces the choice. Default. Refuse to pay bondholders, which would collapse the global financial system because treasuries are the collateral for trillions in other transactions. Or print unlimited money to pay bondholders, which causes hyperinflation and destroys the currency. There's no good option. Both paths lead to catastrophic wealth destruction for anyone holding dollar-denominated assets. And that includes your savings account, your retirement fund, your paycheck, all denominated in dollars, all vulnerable. Now, I know what you're thinking. This sounds extreme. This sounds like fear-mongering. But let me ask you something. Does it sound more extreme than Silicon Valley Bank collapsing in 2 days? Does it sound more extreme than the Fed printing $9 trillion in response to COVID? Does it sound more extreme than the U.S. government paying over $1 trillion annually just in interest? Everything I just described has happened before, multiple times, in different countries with different currencies. The pattern is always identical. Excessive debt, rising interest costs, loss of confidence, cascade, collapse. The only variable is timing, and major financial institutions, by repositioning now, are telling you they think the timing is closer than the mainstream narrative admits. Let's bring this down from macro theory to your actual daily life. Because when the bond market breaks, it doesn't just affect banks and governments. It affects you directly and immediately. Start with mortgage rates. Mortgage rates are tied directly to Treasury yields. When Treasury yields rise, mortgage rates rise. Right now, the average 30-year fixed mortgage rate is hovering around 6.8%. That's already high by recent standards. But if Treasury yields spike in a crisis, mortgage rates could hit 9%, 10%, even 12%. And here's the thing that keeps me up at night. These aren't amateurs making emotional decisions. These are institutions with access to data you and I will never see, running models that cost millions to develop, staffed by people whose entire careers depend on being right about this stuff. So when they start moving in the same direction at the same time, heading for the exits on supposedly risk-free assets, maybe we should pay attention. Because by the time this becomes obvious to everyone else, the smart money will already be positioned. And the rest of us? We'll be the ones left holding the bag. Let me walk you through what's actually happening right now, why it matters more than anything else in finance, and what you can do about it while there's still time to act. At 12%, the monthly payment on a $300,000 mortgage is over $3,000. At current 6.8% rates, it's under $2,000. That's an extra $100 per month. Most people can't absorb that. Home sales would freeze, prices would crash. Homeowners who bought at the peak would find themselves underwater, owing more than the house is worth. Next, your retirement accounts. If you have a 401k or IRA, chances are good that a significant chunk is in bond funds. Bonds are supposed to be the safe part of your portfolio, the stability anchor. But when bond prices fall, those funds lose value. In 2022, when the Fed started raising rates aggressively, the Bloomberg Aggregate Bond Index fell 13%. That was the worst year for bonds in decades. And rates only went from near zero to about 5%. Imagine what happens if rates spike from 5% to 10%. Bond funds could lose 30%, 40%, maybe 50% of their value. Your safe money? Gone. Third, your job. When interest rates spike, businesses that depend on borrowing get crushed. Commercial real estate, which is already in crisis with empty office buildings everywhere, would collapse completely. Construction would halt. Manufacturing that depends on equipment loans would contract sharply. Retail operating on thin margins and credit lines would see mass closures. Unemployment would spike, not gradually, fast. During the 2008 financial crisis, unemployment went from 4.7% to 10% in less than 2 years. And that crisis started in housing. A Treasury crisis would be significantly bigger and more systemic. Fourth, inflation. If the government chooses to print money rather than default, you get real inflation. Not the 3% we complain about now. I'm talking about 10%, 20%, 30% or more. Your paycheck stays the same, but groceries cost twice as much. Gas doubles. Rent doubles. You effectively become poorer overnight without losing your job. This isn't hypothetical. This happened in the United States in the 1970s. It's happened in Argentina multiple times. Turkey experienced it in the past decade. Venezuela is living through it right now. When governments print money to pay debts, the people holding that currency pay the price. And fifth, your ability to prepare disappears. Right now, you can still move money. You can still buy assets. You can still take action. But in a crisis, capital controls get implemented. Banks limit withdrawals. International transfers get blocked. Asset prices become disconnected from fundamentals because nobody can transact freely. By the time the crisis becomes obvious to everyone, it's too late to act. The exits are jammed. The doors are closing. This is why major institutions are repositioning now in early 2026, when the mainstream narrative says everything is fine. Because they know that when everyone else sees the problem, the exit will be completely blocked. So what changed recently that triggered this massive repositioning? Several factors converged at once. First, the Federal Reserve's balance sheet. During COVID, the Fed bought over $4 trillion in Treasury bonds to support the economy. Their balance sheet ballooned from around $4 trillion to $9 trillion. Then, starting in mid-2022, they began quantitative tightening, letting bonds roll off without replacement. As of December 2025, the Fed ended quantitative tightening, with their balance sheet sitting around $6.5 trillion. They reduced by roughly $2.5 trillion. That's $2.5 trillion in bonds that private markets had to absorb. And as we've seen, private markets don't want them. Banks are selling, not buying. Second, the deficit exploded again. After briefly shrinking to around $1 trillion, it's back up to roughly $2 trillion for fiscal year 2026. The government is borrowing $2 trillion in a single year. That's $2 trillion in new bonds that need buyers. And the buyers are disappearing. Third, geopolitical instability. Multiple conflicts creating uncertainty. U.S.-China economic tensions with tariffs and sanctions. Global trade fragmenting. Countries are actively looking for alternatives to the dollar system. The BRICS nations are developing payment systems that bypass U.S. banks entirely. The dollar's dominance, which is the only reason anyone wants Treasury bonds in the first place, is being challenged. Fourth, persistent inflation. The Fed claimed inflation was transitory in 2021. They were wrong. They claimed they could bring it back to 2% without breaking anything. That hasn't happened. Core inflation is still running above 3%. The market is losing confidence in the Fed's ability to control prices without causing serious economic damage. And fifth, commercial real estate. This is the hidden crisis nobody's talking about enough. Office buildings in major cities are empty. Work from home is permanent for many sectors. Property values have fallen 30% to 50% in some markets. There's roughly $930 billion in commercial real estate loans maturing in 2026 alone. When these loans come due, they can't be refinanced at anything close to the original terms. The properties are worth less and rates are higher. That means defaults, massive defaults. And when those defaults hit bank balance sheets, we get another Silicon Valley Bank scenario, but bigger, much bigger. The institutions see this coming. That's why they're reducing commercial real estate exposure and getting defensive across the board. Now let me play devil's advocate for a moment, because you need to hear the other side of this argument. The mainstream will tell you that banks' repositioning is normal portfolio management. They'll say Treasury yields, while higher than during COVID, are still reasonable historically. In the 1990s, the 10-year yield was over 6%. In the 1980s, it topped 10%. They'll point out that the U.S. economy is the strongest in the world. Unemployment is relatively low. GDP growth is positive. Corporate earnings are solid. There's no immediate crisis visible. They'll remind you that people have been predicting dollar collapse for decades, and it hasn't happened. The debt has been growing since World War II. The deficit has been large for 50 years. We survived the 1970s inflation. We survived 2008. We survived COVID. The system is resilient, and they'll emphasize the dollar's unique position. The U.S. dollar is the global reserve currency. International trade is conducted in dollars. Oil is priced in dollars. Central banks hold dollars as reserves. Even if the U.S. has problems, there's no viable alternative. The euro has its own debt issues. The yuan isn't freely convertible. Gold can't serve as a transaction currency at scale. The dollar wins by default. These are legitimate arguments. They have merit. The dollar's reserve status does give the United States extraordinary privilege. The ability to borrow in your own currency is a massive structural advantage, and the system has survived predictions of collapse many times before. But here's what that argument misses completely. Systems don't fail gradually. They fail suddenly. Silicon Valley Bank was fine until it wasn't. Lehman Brothers was fine until it wasn't. The housing market was fine until it wasn't. Confidence is essentially binary. It exists or it doesn't. And when it disappears fast. The fact that the system survived previous crises doesn't guarantee it will survive the next one. In fact, each crisis makes the system more fragile because the response to each crisis is more debt, more leverage, more money printing. The fire extinguisher is getting smaller while the fire is getting bigger. Major financial institutions aren't repositioning because they're worried about normal business cycle risk. They're repositioning because they see systemic risk. And their track record of navigating crises successfully suggests we should pay very close attention to what they're doing. So what do you actually do with this information? Because understanding the problem is only valuable if it leads to action. And there are specific, concrete steps you can take right now to protect yourself. First, reduce your exposure to long-duration bonds. If you own bond funds in your retirement account, especially long-term bond funds, consider shifting toward shorter-term bonds or money market funds. Yes, you'll earn less interest, but you'll avoid the catastrophic losses that come when long-term bond prices collapse. Second, build serious cash reserves. I know cash loses value to inflation, but cash gives you optionality. When assets go on sale in a crisis, having cash means you can buy. Aim for 3 to 6 months of expenses in a high-yield savings account, not invested, liquid. Third, consider hard assets. Real estate in areas with strong fundamentals, not speculative markets, productive land, commodities, things with intrinsic value that don't depend on government promises. Gold and silver have served as stores of value for thousands of years across every civilization. They don't pay interest, but they also don't default. Fourth, reduce or lock in your debt. If you have variable rate debt, lock in fixed rates now while you still can. If you have high interest debt, pay it down aggressively. In a crisis, access to credit disappears. The people who survive are the ones who don't need to borrow. Fifth, diversify your income streams. If your income depends entirely on one employer in one industry, in one country, you're exposed. Develop skills that have value in multiple contexts. Build side income streams. Create redundancy in your financial life. Sixth, stay informed, but don't panic. The timeline for this crisis could be months or could be years. Acting rashly based on fear is just as dangerous as ignoring the warning signs. Make deliberate, calculated moves. And seventh, understand that the goal isn't to get rich from the crisis. The goal is to survive it with your wealth intact so you can take advantage of opportunities on the other side. Wealth isn't destroyed in crises. It's transferred from those who didn't see it coming to those who did. Let me bring this full circle. Major financial institutions have been systematically repositioning away from Treasury securities, not because they need the cash, not because they're making room in their portfolio for other opportunities, but because their analysis, their models, their decades of experience tell them that holding those bonds is a losing proposition. They see a government trapped by debt. They see interest costs spiraling toward levels that consume the entire budget. They see foreign buyers backing away. They see inflation that won't return to 2% without causing serious economic pain. They see commercial real estate teetering on the edge. They see a Federal Reserve that can't raise rates without triggering a crisis and can't lower rates without causing inflation. They see a system that has exhausted its options, a system that has kicked the can down the road for so long that there's no road left. A system where the only remaining choice is between different varieties of economic catastrophe. And so they're repositioning, quietly, systematically. While financial media talks about soft landings and resilient consumers and the strength of the American economy. This isn't conspiracy theory. This is documented fact. The regulatory filings are public. The numbers are real. The repositioning is happening right now. conducted by institutions that have survived every crisis in modern history by seeing problems early and positioning accordingly. You can dismiss this as fear-mongering. You can trust that the government and the Federal Reserve have everything under control. You can believe that this time is different, that the rules have changed, that debt doesn't matter anymore. Or you can look at what the smartest money in the world is actually doing and ask yourself a simple question. Do they know something I don't? The answer is yes, they absolutely do. They have access to data you'll never see. They have relationships with policymakers you'll never meet. They run models analyzing scenarios you can't imagine. And those models are screaming one thing loud and clear: get defensive now. History will eventually show whether they were right. But by the time history makes that judgment, the opportunity to act will be completely gone. The exits will be jammed. The losses will be locked in. Major institutions made their moves throughout 2025 and early 2026. They're positioned for what comes next. The only question remaining is, are you? If this breakdown has opened your eyes to what's really happening behind the headlines, if you want to stay ahead of the curve instead of getting caught in the stampede, then do me a favor right now. Smash that subscribe button and hit the notification bell. Because what we just covered isn't the end of this story, it's barely the beginning. The moves happening right now in institutional finance are setting the stage for the biggest wealth transfer of our generation, and you need to know which side of that transfer you're going to be on. Drop a comment below and tell me, are you repositioning your portfolio, or are you staying the course? I actually read every comment, and your insights might help someone else in the next generation finance community make a critical decision. Let's figure this out together before it's too late. This is not financial advice. Always do your own research and consult with qualified professionals before making investment decisions.